Something extraordinary is happening right now in the global financial system. And if you're not paying attention, you're about to miss one of the most significant wealth transfers in modern history. While most people are distracted by headlines about stock market rallies and cryptocurrency drama, the world's most powerful institutions are quietly making a move that will reshape the entire global economy. And at the center of this shift, gold. But this isn't just about gold going up in price. This is about a fundamental restructuring of how power works on the world stage. And the implications for your wealth, your retirement, and your financial security are massive. Let me show you what's really happening. For decades, the United States dollar has been the undisputed king of global finance. It's been the world's reserve currency since the end of World War II. Every major commodity, from oil to wheat to copper, has been priced in dollars. International trade has been conducted in dollars. Central banks around the world have held the majority of their reserves in dollar-denominated assets. This system gave the United States an extraordinary advantage. It meant we could print money to finance our spending, and the rest of the world would absorb that inflation by holding our currency. It meant we could impose sanctions on countries and effectively cut them off from the global financial system. It meant American financial institutions sat at the center of every major transaction on the planet. But that system is cracking, and the cracks are turning into fissures. Here's what's happening behind closed doors. Central banks around the world are dumping dollars and buying gold at a pace we haven't seen in over 50 years. We're not talking about small adjustments to their portfolios. We're talking about a wholesale restructuring of how these institutions think about reserves and security. In the most recent period, central banks added over 1,000 tons of gold to their reserves. 1,000 tons. To put that in perspective, that's more gold than most countries have accumulated in their entire history. And this isn't slowing down. If anything, it's accelerating. Who's leading this charge? The BRICS nations: Brazil, Russia, India, China, and South Africa. But it's not just the original five anymore. The BRICS alliance has been expanding rapidly, with countries like Saudi Arabia, the United Arab Emirates, Egypt, and Iran either joining or expressing serious interest. These aren't small players. Together, these nations represent over 40% of the world's population and more than a third of global GDP. And they're all moving in the same direction, away from the dollar, toward gold. China's central bank has been on an absolute buying spree. Month after month, they're adding to their gold reserves. The official numbers show them holding around 2,300 tons. But here's what most analysts won't tell you. Those official numbers are almost certainly understated. China has a long history of accumulating gold quietly and only reporting their holdings years later. Some estimates put their actual reserves at double or even triple the official figure. Why would they hide it? Because if the world knew the true extent of China's gold accumulation, it would trigger a panic in currency markets. The dollar would weaken dramatically, gold prices would spike, and China would lose the advantage of being able to buy more gold at current prices. Russia has been even more aggressive. After facing sanctions from Western nations, they made a strategic decision. They couldn't rely on holding dollars or euros if those assets could be frozen at any moment. So they converted a massive portion of their reserves into gold. Russia now holds over 2,300 tons of gold officially, making them one of the top 5 holders in the world. But here's where it gets really interesting. Russia and China aren't just buying gold for their central banks. They're building an entirely new financial infrastructure that bypasses the dollar system completely. They've created alternative payment systems. China has the Cross-Border Interbank Payment System, or CIPS. Russia has its own system. These allow countries to trade with each other without ever touching the dollar. And increasingly, they're settling these trades in their own currencies, or in gold. Think about what this means. For the first time in 70 years, there's a viable alternative to the dollar-based system. Countries that have been frustrated by American sanctions or worried about the stability of the dollar now have options, and they're taking them. India has been quietly accumulating gold as well. Their central bank has been a consistent buyer, adding hundreds of tons to their reserves. But what's really fascinating is what's happening at the consumer level in India. Indian households hold an estimated 25,000 tons of gold. That's more than the official reserves of the United States, Germany, and Italy combined. Gold is deeply embedded in Indian culture, and as the country's middle class grows, so does their demand for gold. The Middle Eastern nations are making moves too. Saudi Arabia, which has been the cornerstone of the petrodollar system for half a century, is now open to accepting payment for oil in currencies other than dollars. That's a seismic shift. The petrodollar system has been one of the main pillars supporting dollar dominance. If that pillar crumbles, the entire structure becomes unstable. The United Arab Emirates has been accumulating gold. Qatar has been accumulating gold. Even smaller nations that you wouldn't expect are building their gold reserves at unprecedented rates. So why is this happening now? What changed? Several factors are converging at once. First, there's the sheer amount of money printing that happened in response to the financial crisis, and then again during the pandemic. The Federal Reserve expanded its balance sheet by trillions of dollars. The European Central Bank did the same. The Bank of Japan has been printing money for decades. All of this currency creation has eroded confidence in fiat money. Central bankers around the world look at this and think, if the United States can just print unlimited dollars to solve their problems, what does that mean for the value of the dollars we're holding in our reserves? The answer is obvious. Those dollars are worth less, and they're going to be worth even less in the future. Second, there's the weaponization of the dollar through sanctions. When Russia invaded Ukraine, Western nations froze Russian central bank assets. Hundreds of billions of dollars, just frozen. Now, you might think Russia deserved that. But if you're a central banker in China or Saudi Arabia or anywhere else, you're watching that and thinking, if they can do that to Russia, they could do it to us. Suddenly, holding your reserves in dollars or euros doesn't seem like such a safe bet, because those assets can be taken away from you with the stroke of a pen if you fall out of favor with Western governments. Gold, on the other hand, can't be frozen. It can't be sanctioned. If you hold physical gold in your own vaults, it's yours, period. Third, there's the growing economic power of the East. For decades, the West dominated global GDP, but that's changing rapidly. China is now the world's second-largest economy and is on track to become the largest within the next decade or two. India is growing at an incredible pace. Southeast Asian nations are booming, the economic center of gravity is shifting eastward, and the financial system is starting to shift with it. These countries are asking a reasonable question. Why should we conduct all of our trade in dollars when most of our trading partners are in Asia? Why should we be subject to American monetary policy when our economies are growing faster than America's? And they're finding that gold provides an answer. Gold is nobody's liability. It's not subject to any single country's monetary policy. It's accepted everywhere. It's been a store of value for thousands of years. In a multipolar world where no single currency dominates, gold becomes the neutral reserve asset that everyone can agree on. Now here's where this gets personal for you, because this shift isn't just happening at the central bank level. It's starting to filter down to institutional investors, and eventually, it's going to hit the retail market. Major investment firms are already positioning for this. They're increasing their gold allocations. They're launching new gold-backed products. They're advising their wealthy clients to hold more physical precious metals, because they can see where this is going. When central banks are buying an asset aggressively, that's a signal. These are the most sophisticated, well-informed institutions in the world. They have access to data and analysis that the rest of us can only dream about. And they're voting with their reserves. They're saying, gold is the safe haven. Gold is the asset that will hold value when everything else is uncertain. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties and why more people are making this move right now. Worth checking out if that's relevant to your situation. Anyway, back to what's happening in the markets. The price action in gold has been telling this story for anyone paying attention. Gold has been making new all-time highs, even as the stock market has been volatile and interest rates have been elevated. Traditionally, gold struggles when interest rates are high because it doesn't pay a yield. But that relationship has broken down. Gold is rising anyway. Why? Because the demand from central banks is so strong that it's overwhelming all other factors. When you have institutions buying thousands of tons of gold, that creates a floor under the price. And it creates upward pressure that eventually breaks through resistance levels. But here's what most people don't understand. The gold market is relatively small compared to other financial markets. The total value of all the gold ever mined is around $15 trillion. That sounds like a lot, but compare it to the global bond market, which is over $130 trillion, or the global stock market, which is around $100 trillion. What happens when even a small percentage of that money starts flowing into gold? The price goes parabolic. We saw this in the late 70s and early 80s. Gold went from $35 an ounce to over $800 in less than a decade. That's not a 20% gain or a 50% gain. That's a 20-fold increase. Could we see something similar now? The conditions are arguably even more favorable than they were back then. The amount of currency in circulation is vastly higher. The level of debt is vastly higher. The geopolitical tensions are arguably more severe. And now you have this coordinated move by central banks around the world to accumulate gold. Let me paint you a picture of what this could look like. Imagine you're a pension fund manager. You've got billions of dollars to invest, and your job is to make sure there's enough money to pay retirees decades from now. You've been holding a traditional portfolio, 60% stocks, 40% bonds, maybe a small allocation to alternatives, but now you're watching what's happening. You're seeing central banks dump bonds and buy gold. You're seeing the dollar weaken against other currencies. You're seeing inflation remain stubbornly high despite interest rate increases. You're seeing geopolitical risks escalate. You start thinking, maybe I need to protect this portfolio. Maybe I need an asset that's not correlated to stocks and bonds. Maybe I need something that will hold value if the financial system goes through a major disruption. So you decide to allocate 5% of your portfolio to gold, just 5%, but you're managing $10 billion. That's $500 million flowing into gold. Now multiply that by thousands of pension funds, insurance companies, sovereign wealth funds, and endowments around the world, all making the same calculation, all deciding they need more gold. That's an enormous amount of capital chasing a relatively small market. And it pushes prices higher, which attracts more attention, which brings in more buyers, which pushes prices even higher. It becomes a self-reinforcing cycle. We're already seeing the early stages of this. Gold ETFs have been seeing inflows after years of outflows. Retail demand for physical gold coins and bars has been strong. Jewelry demand in Asia remains robust. And on top of all that, you have the central bank buying that just won't stop. The supply side of the equation makes this even more compelling. Gold mining production has been essentially flat for years. It's getting harder and more expensive to find new deposits. The easy gold has already been mined. New projects take years to develop and require massive capital investment. And even when new mines come online, they're often lower grade than the mines of the past, meaning you have to process more ore to get the same amount of gold. Meanwhile, demand is surging. You've got central banks buying, you've got investors buying, you've got consumers in Asia buying, and supply can't keep up. That's the classic setup for a sustained bull market. But let's zoom out even further, because this isn't just about gold prices. This is about a fundamental shift in the global order. For the past 75 years, we've lived in a world where American power was unquestioned. The dollar was king. American financial institutions were the gatekeepers of global capital. American military might backed up American economic interests. That world is ending. Not overnight, not in a dramatic collapse, but gradually, inexorably, the balance of power is shifting. And gold is both a symptom of that shift and a catalyst for it. When countries hold their reserves in dollars, they're essentially lending money to the United States. They're financing American spending. They're supporting American power. But when they convert those dollars to gold, they're taking that support away. They're saying, we don't want to be dependent on your system anymore. We want to be independent. This has profound implications. It means the United States will have a harder time financing its deficits. It means interest rates might have to stay higher to attract foreign buyers of treasury bonds. It means the dollar could weaken significantly over time, and it means American living standards, which have been subsidized by the rest of the world's willingness to hold dollars, could come under pressure. For Americans, this is a wake-up call. The free ride is ending. The ability to print money without consequences is ending. The world is moving toward a more balanced, multipolar system. And in that system, gold is the ultimate neutral asset. But here's the thing. This shift creates enormous opportunities for those who position themselves correctly. If you understand what's happening, if you can see the trend before it becomes obvious to everyone, you can protect your wealth and potentially grow it substantially. Think about the people who bought gold in the early 70s, before the big run-up. They saw the writing on the wall. They understood that the Bretton Woods system was breaking down. They knew that inflation was going to surge, and they positioned themselves accordingly. Those people made fortunes. Or think about the people who bought gold in the early 2000s, after it had been in a bear market for 20 years. They recognized that the fundamentals had shifted. They saw that central banks had stopped selling and started buying. They understood that the massive money printing after the dot-com crash would eventually lead to inflation. And they got in early. Those people also made fortunes. We're at a similar inflection point now. The signs are all there. Central banks are buying at record levels. The dollar-based system is under strain. Geopolitical tensions are rising. Debt levels are unsustainable. Inflation is proving harder to control than policymakers expected. And gold is starting to break out to new highs. The question is, Are you going to recognize this moment for what it is? Or are you going to look back in 5 or 10 years and wish you had paid attention? Let me be clear about something. I'm not saying you should put all your money into gold. That would be reckless. Gold is a form of insurance. It's a hedge against systemic risk. It's a way to preserve purchasing power when other assets are losing value. But it should be part of a diversified portfolio, not the entire portfolio. Most financial advisors suggest anywhere from 5 to 20% in precious metals, depending on your risk tolerance and financial situation. The key is to have enough that it makes a meaningful difference if gold does what many analysts expect it to do, but not so much that you're overly exposed if something unexpected happens. And here's another critical point. When we talk about gold, we're talking about physical gold, not paper gold, not gold mining stocks, not gold ETFs that might not actually have the gold they claim to have. Physical gold that you can hold in your hand or store in a secure vault. Why does this matter? Because in a real crisis, paper promises might not be worth much. We've seen this throughout history. When things get bad, people want the real thing. They want physical assets they can touch and control, not claims on assets that might or might not exist. The gold market has a dirty little secret. There's far more paper gold trading than there is physical gold in existence. Futures contracts, options, ETFs, certificates, all of these represent claims on gold. But if everyone who held these paper claims tried to take delivery of physical gold at the same time, there wouldn't be nearly enough to go around. This creates a situation where the paper price and the physical price could diverge dramatically in a crisis. You might see gold trading at $3,000 an ounce on the futures market, but try to buy a physical gold coin, and you're paying $4,000. Or you can't get one at all because dealers are sold out. That's why serious investors and central banks focus on physical gold. They want the real asset, not a promise, and that's what you should be thinking about too. Now let's talk about timing, because one of the most common objections I hear is, gold is already at all-time highs. Isn't it too late to buy? Here's the thing about all-time highs. Every major bull market is characterized by a series of all-time highs. Gold hit all-time highs in the 70s, and then it went up another 500%. Gold hit all-time highs in the 2000s, and then it doubled from there. When you're in the early stages of a major trend, all-time highs are just the beginning. They're not the end. The real gains come after the breakout, when the trend is established and momentum builds. And we have every reason to believe we're in the early stages of this trend. Central bank buying is accelerating, not slowing down. The geopolitical drivers are intensifying, not resolving. The monetary conditions are becoming more favorable, not less. All of the factors that drive gold higher are in place and strengthening. Plus, when you adjust for inflation, gold isn't even close to its all-time high. Back in 1980, gold peaked at around $850 an ounce. But in today's dollars, adjusted for inflation, that would be over $3,000. So even at current prices around $2,700, gold is still below its inflation-adjusted peak. That suggests there's significant room to run, especially if we see the kind of monetary chaos that many analysts are predicting. If inflation comes back with a vengeance, if the dollar weakens substantially, if we see a major financial crisis, gold could easily surpass its inflation-adjusted highs and go much higher. Let me give you another way to think about this. The total value of all the gold in the world is around $15 trillion, as I mentioned earlier. The total value of global financial assets, stocks, bonds, real estate, everything, is somewhere around $500 trillion. That means gold represents about 3% of global financial assets. Historically, during times of crisis or major monetary shifts, that percentage has gone much higher. In the late 70s, gold represented a much larger share of global wealth. If we were to see gold return to even 5 or 6% of global financial assets, that would imply a gold price well over $4,000 an ounce. If it went to 10%, which is not unprecedented in historical terms, you're looking at gold over $8,000 an ounce. These aren't wild predictions. These are just mathematical calculations based on historical precedents and current market sizes, and they show you the kind of potential we're talking about. But beyond the price potential, there's something else to consider. Peace of mind. In a world that feels increasingly unstable, where geopolitical tensions are rising, where the financial system seems fragile, where inflation is eroding purchasing power, there's real value in having an asset that stood the test of time. Gold has been money for 5,000 years. It survived the fall of empires, the collapse of currencies, wars, depressions, and every kind of crisis imaginable. It's the ultimate form of financial insurance, And in times like these, insurance is worth having. Think about what's happening in the world right now. We have major conflicts in multiple regions. We have a growing divide between East and West. We have unprecedented levels of government debt. We have central banks that are trapped between fighting inflation and supporting economic growth. We have a banking system that's shown cracks. We have political instability in many major countries. Any one of these factors would be concerning. All of them together create a very uncertain environment. And in uncertain environments, gold shines. It's the asset people turn to when they don't know what else to do, when they want to preserve what they have, when they want to make sure they'll be okay no matter what happens. The wealthy have always understood this. That's why rich families have held gold for generations. That's why central banks hold gold. That's why the smartest investors in the world have significant gold positions. They're not trying to get rich from gold. They're trying to stay rich. They're trying to make sure their wealth survives whatever comes next. And that's what you should be thinking about too. Not how much money can I make from gold, but how can I protect what I have? How can I make sure my family is secure? How can I preserve my purchasing power in a world where currencies are being debased? When you frame it that way, the decision becomes clearer. Gold isn't a speculation. It's a necessity. It's a core holding that every serious portfolio should have, especially now when all the signs are pointing toward major changes in the global financial system. The shift in world power that's happening right now isn't going to reverse. China isn't going to suddenly decide to hold more dollars. Russia isn't going to abandon its gold accumulation strategy. The BRICS nations aren't going to give up on creating an alternative to the Western financial system. This is a long-term trend that's going to play out over years and decades. And as it plays out, gold is going to become increasingly important. It's going to be the bridge between the old system and the new system. It's going to be the asset that maintains value while everything else is in flux. It's going to be the safe haven that people flee to when they're scared. We're watching history unfold in real time. The post-World War II order is breaking down. A new multipolar world is emerging, and gold is at the center of this transformation. The question isn't whether this is happening. The question is whether you're going to position yourself to benefit from it. Because make no mistake, this shift is going to create winners and losers. Those who understand what's happening and take action will protect and grow their wealth. Those who ignore the signs and stick with the status quo are going to see their purchasing power eroded. They're going to watch their savings lose value. They're going to be on the wrong side of the biggest wealth transfer in modern history. You have a choice to make. You can dismiss this as just another gold bug prediction. You can assume that the system will muddle through like it always has. You can hope that your stocks and bonds will be enough to see you through retirement. Or you can look at what the world's most powerful institutions are doing and follow their lead. Central banks are buying gold for a reason. They see something coming. They're preparing for a world that looks very different from the one we've known. And they're making sure they have the ultimate form of money, the asset that's been trusted for millennia, in their vaults. Shouldn't you be doing the same? Shouldn't you have at least some portion of your wealth in the one asset that's proven itself time and time again? The one asset that can't be printed, can't be debased, can't be frozen by governments, and can't go to zero? This is your moment. This is your opportunity to get ahead of the curve, to position yourself before the crowd figures it out, to make the move that your future self will thank you for. The massive shift in world power has started. The only question is whether you're going to be ready for what comes next.